I'm Steele Rose, editor of CPA Magazine. Today I'm with Martin Shenkman, author of several books for attorneys and accountants. Mr. Shenkman writes a planning advisor column for CPA Magazine. I'm looking forward to Martin's perspective on a number of topics as we prepare for another intriguing tax year. Let's start with any critical tax tips, Mr. Shenkman. Are there any tips that stand out among others?
There's a number of interesting things that tie into the 1040 planning and estate planning. I see many errors where practitioners are not certain or not clear or misadvised perhaps about the tax status of trusts and whether or not they flow through to the individual's 1040. The predominant theme, if you will, of most trusts that have been created certainly since 2012 have been that they're grantor trust, meaning the income is taxed to the grantor setting it up. And too often I see situations where practitioners have reported these as complex trusts or simple trusts passing the income out to the beneficiaries instead of reporting the income on the returns of the grantor. Grantor trusts also raise a number of very important, very important planning opportunities and issues. And too often if the CPA practitioner that's doing the 1041 for the trust and the 1040 where the income should be going through is not bringing these issues up to the client, nobody may be. So for example, one really vital issue, especially for older or infirm, ill clients, is that many of these trusts are structured with what's called a swap power. It gives the grantor the right to swap cash into the trust in exchange for highly appreciated assets. And as you're all aware, you want to bring highly appreciated assets out of an irrevocable trust into the client's estate so he gets a basis step up on death. Critical part of income tax planning. I don't want to say the norm is that everybody ignores those powers, but let me just sort of say that there are far too many times where I see that nobody's watching the cookie jar, and this is a big tax cookie jar. So even if you don't view yourself as a trust guru, you really need to just raise some of these issues. If you don't, no one may do it. Now, one of the problems I see is that these issues aren't raised because some practitioners don't even have a copy of the trust in a permanent file or haven't really reviewed the trust. What you must do is when you file a 1041 for the first time is you have to bill the client something extra, get a copy of the trust instrument and the documents that put assets into that trust, and make sure you understand what it is. And if need be, you may have to say to the client, listen, I need a half an hour to an hour of the attorney's time who created this trust to understand what I need to do from a tax perspective. And if you simply do a conference call with the attorney, run through the trust, write some margin notes, for those of my age bracket, get out that yellow highlighter and highlight some of the relevant provisions. For other people, I guess you do it electronically. But if you just get some margin notes and highlight some of the relevant provisions and get a little summary of that trust as a cover sheet, you're good to go and you'll do a great job for years to come. Too often, and it's probably because the pressure of clients refusing to give you that extra hour or the hour with the attorney, but too often the work's just not going to be done right without that. So that's sort of a long-winded answer to a very important tax question that I see missed too often.